Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
So with chatting with Michael, he said, that you are awesome, but very difficult to get a hold of. He literally said, you have to chase him.
Well, so, you got the main gatekeeper. So Tessa's she's the holder of all things my calendar. She literally has me running 24/7. So you can blame her for not having enough time to pick up my own phone.
Well, she must be doing a good job.
Yeah, she is definitely doing a good job. I couldn't live my life without her.
Thanks, Chris. I appreciate that, as he's trying to throw me under a bus and then run me back over. I appreciate you sticking up for me.
Well, cool. Why don't we jump into it? We have a syndication that we put together 6 years ago, and we want to sell it. Well, we're in contract to sell it. And we're almost through the inspection period. We're probably about 30 days away from closing. And we haven't reached out to our partners yet because we've had a few sale fails in the past. So we're kind of
waiting until the inspection period is up before we really sound the alarm bells.
Well, until the earnest money is hard, right? Everybody's committed fully.
Yep.
Got it.
So that's where we're at. But I know of at least two investors who want their cash out. AJ and I are working diligently on finding the next leg up. So, essentially, we're trying to limit the liability of an exchange being invalidated.
Okay. All right.
And then and then we have another.
Chris, I think let's get to the question. We understand that there's the swap and drop and swap kind of process,
right?
And for our listeners and for everyone, I think we could all benefit if you could give us kind of an explanation of how that works and what it is.
Yeah, of course. So the IRS has this special code that some people may still not have even heard of. It's my favorite part of the tax code, and it's Section 1031. It allows investors, such as your retail investors, to essentially sell what the IRS calls a relinquished property and replace it with what they call a replacement property, and do that in a tax-free manner. So they're able to actually shelter the gains that they've received. So what happens when you have syndicators, operators, sponsors, I use those terms interchangeably with one another, who own a property, they have investors. Some of those investors theoretically don't want to take the cash and pay taxes, and other investors want the cash and to pay taxes, but they all are in the same entity with one another. And that same entity is currently what we would call a special purpose entity that the lender required us to form at acquisition of the property that we're selling. We do what AJ said, and it's called a drop and swap. So it's essentially taking, and this is done usually through a ballot process. So we're contacting all of the investors, telling them exactly what we're doing, and asking them whether they want to go through a forward exchange or whether they want to take their cash and pay their taxes. I should say, this is not a magic wand, right? So 1031 is a tax deferral process. It's not a tax waiver process. So the taxes that you would pay on the gains from the sale of the property, you're simply deferring those until they ripen. Now, ultimately, I have clients who for generations have essentially done 1031s, and that is theoretically you're able to waive all those taxable gains through a step up in basis. But ultimately, what we want to do is we want to give investors a choice. We want to be able to give them usually through a ballot process. You're basically asking them affirmatively, do you want to get out of this deal, or do you want to go with us into the next deal? And for people that say, yes, I want to go through the next deal, they're going to be staying in the same entity because that entity is what we call seasoned, meaning it's owned the property for a number of years and it's not the newly formed entity. Investors who want their cash and are prepared to pay their taxes are dropped into a new entity. And essentially what we do is we create what's called a tenant in common structure. That simply means from the IRS's perspective that there are now two owners of what the IRS calls undivided interests in real property. So take your apartment building, for example. If you were to give your investors choice as to whether to take their money through the form of distributions and pay their taxes on their personal tax returns, or to stay in the same entity and go forward through a forward exchange, which you, the sponsors, would be able to choose the next investment opportunity, just like you chose the investment opportunity that the investors invested in the first time. We create another entity. That entity has a similar operating agreement, and we simply drop investors from the existing entity into that entity, thereby creating essentially two owners of the same piece of real property, and that's what we call a tenant in common structure. So that's kind of like a 30,000 foot viewpoint of the structure and kind of the mechanics behind it. But ultimately, it's trying to give investors more choice. And from a sponsor's perspective, it's obviously you're helping your investors find a replacement investment. And most retail investors, as you guys know, right, they don't want to be asset managers. They don't want to be sponsors, operators, syndicators. That's why they invested with you. They want you to find the next investment opportunity for them, and this provides them an excellent resource to do so.
Nice. And the tenant in common, I often hear just ticks.
Yes.
As like a nomenclature, or kind of like abbreviated. Cool. So when we go into the new property, presumably it's going to be another syndication. It's going to be a leg up. So, for rough numbers, I mean, like, say we have 500K from this one sale, and we've got to raise 2 million for the next sale. Like, my understanding is that we have to come in with a tick as well into the new property. So, like, how does like the original swap get put into the syndication, like, after you get into the next leg up?
Right. So let's think about the structure this way. So you're in the process of selling this apartment building. You have some investors who have decided, yes, I want to go into this next investment opportunity. AJ and Chris have. So we go through the closing process. That money that theoretically is going to be invested as a tick goes to what we call a qualified intermediary. That's simply like an escrow officer that maintains the safe harbor provisions of the 1031 process.
Sure, and that's like an exchange company, right? They
that's like an exchange company.
Yeah, part of the 1031 is you can't touch the money, right? Like, if I touch the money, that's like, we're done.
You're dirty.
Taxes.
Uncle Sam is waiting with his mitts fully out, ready to stuff them in both of your pockets. If you touch the money, he gets the ability to pull taxes from you. If you don't touch the money through the qualified intermediary, he can't do that. But you're touching on one of the other important points, and that is the IRS requires the same taxpayer that sold the replacement property to be the same taxpayer on the replacement property. So when you think about the next investment opportunity, that will also be a tick. It will also be a tenant in common structure. And if you're syndicating the balance of the equity, and when we say equity, I like to use the analogy most people bought their, if they own their own residential home, they showed up at the title company. The title company said, what's the down payment? When we talk about syndicating equity, what we're really talking about is syndicating the down payment that's required in order to get the loan to buy the asset. And because these are large apartment buildings or large transactions, not all of us are carrying around a suitcase full of cash. So we need to have multiple people participate and contribute their cash. So in your case, you've got a good head start. You've got a good head start on that down payment because you've got money that's sitting at a qualified intermediary that's going to be one of the owners of the next piece of property, but you don't probably have enough with just the 1031 money to fully fill out the down payment. So we have to syndicate separately that down payment. And that down payment will be syndicated through another entity, and that entity will also take ownership in the next piece of real property, and you'll have a tick. So whereas the drop and swap is creating a tick at the end of the transaction, a tick on reinvestment will be created at the opening, at the acquisition of the new piece of property.
Right. And then my understanding too, and I'm probably educated just enough to be dangerous.
Okay.
But so, we swap into this new property. So now we've got two ticks. The syndication raised, 75% of the money, and the swap tick had 25% of the money. Like the 1031 tick has to season before you can then really like drop it into the syndication. I mean, I guess I'm just kind of unclear how maybe that works. I mean,
yeah,
maybe I have like the overall 40,000 foot view of it, but
right. So you're actually not going to be the tick that's coming into your next investment's not going to be an investor in your next syndication. They'll actually be a co-owner of the same piece of real property. So when you're going to look for leverage with whether it's an agency, Freddie or Fannie, or whether it's a bridge lender, or if it's even like a hard money lender or a local community bank, you're going to want to make sure that you tell them that there's going to be at least two borrowers. There's going to be at least two co-owners of that same piece of real property. So you don't need that 1031 money that's sitting at the qualified intermediary to season to invest into your next syndication. They just continue into that investment, and then provided that your lender allows a tenant in common structure to exist, you'll have two borrowers, two co-owners, but the same sponsor group will control both borrowers. So that's the key, right? So the same sponsor group will control both.
Yeah, the sponsor, we will be the sponsor in this kind of like scenario, and we will be the controller of both those entities. But I guess my
I was just gonna say you hit on an important point from the standpoint of, imagine if you wanted to do a HUD deal. So HUD is an agency lender. It does not allow ticks. So when we do a HUD deal, we really have to utilize what's called a roll-up structure. And most CPAs will tell you that an entity, to AJ's point, has to be seasoned before it gets into another entity where essentially it now receives K1s and partnership returns. There's a famous tax court case out there where the tax court allowed that to take place and basically said it's okay to utilize a roll-up in this context. But most CPAs will say you need to have had the investment for at least a year, which is like the short-term capital gains period. So that's the only context of when we're really talking about a seasoning that needs to take place, and it's basically what the hold period is.
So like once you in order to quote unquote perfect the 1031, my understanding was that it needed to season with the property as that tick structure, and then it was able to be dropped into the syndication, because as the GP, I guess the structure and the fees on the new property may be different than the previous property, or like that, like how I'm like, I guess I'm
Right.
unclear as to like how that works and whether there is some sort of requirement or if it's like a gray area. And what I've heard is more of a best in practice as opposed to law or like just a
Right.
requirement.
If you wanted your 1031 company to be an investor directly into the syndication, and you wanted it, so instead of having a tick structure, you said, I don't want a tick structure. I don't like ticks. I just want a single entity, a syndicated entity, and I want my 1031 entity to essentially be treated as an investor. Most CPAs would say, well, you would have to wait essentially year before you essentially drop them into another entity, and that would be that seasoning period. So we try to take out that level of uncertainty or that level of grayness, or the possibility of, if we were in the unlikely position of picking up an audit or having to fight this in tax court, to maintain that tick structure. And then for people like AJ or Chris or other sponsors that have a deal where the economics of the promote, meaning the carried interest or the fees that you're hoping to have, may have changed from the original investment into the next investment. And that's okay. And we're able to achieve those same economic realities that the sponsors want by having the sponsors as non-member managers. So in other words, you maintain the same taxpayer side on the tick investment, and you're not requiring to have a seasoning before you're adding new members in there or anything like that. And you're able to essentially lay them out in the operating agreement as fees. So let's say your first deal was like an 80-20 deal, and your next deal, you're doing a 70-30 deal with an 8% pref, right? So that next deal, the sponsors obviously are receiving 30%. And so those sponsors will be the non-member manager, meaning the original manager of the entity that's going through that 1031 process or that exchange process might not be the same manager on the reinvestment. It might be the manager sponsor entity of the syndication entity, might be the new manager of the 1031 or the tick entity that's coming into the replacement property. And that's how you're able to kind of shape those economics to fit exactly what both the investors are expecting as well as the sponsors are expecting.
So Dugan, we have a deal that we brought in 1031 funds. And so, but it was from someone's personal, personal LLC. They already had an operating agreement for it. And, it's been seasoned for a year. And so we're looking to drop them into the syndication LLC. And then, eventually when we sell, we're interested in what the process is for them to be able to either 1031 out their separate way or to be able to take the boot. I don't know if this particular investor is going to need or want to do that, but that is a question that I've got. So
sure. Yeah. So if they've owned the investment for longer than a year, most conservative CPAs would say that entity is seasoned and it can essentially be rolled into another entity and theoretically receive K1. K1s or a partnership return. Partnership, as you know, in the world of ticks and 1031 is kind of like a dirty word. We don't really use that word because they're really not partners or investors. They're really co-owners of undivided interests in real property. But depending on the facts or the circumstances, that entity has already been seasoned, and it does have the ability through certain structures to be put in there. But I will say this, if the investor already has an LLC, you're able to layer another LLC on top of that LLC and treat it as a disregarded entity for taxation purposes. So it accomplishes what we're talking about from a structural perspective. And that's how most sponsors or syndicators that are in your position do that. So they would essentially create a new co LLC in which the sole equity member is the existing investors LLC, but they would become the non-member manager of that new co. and it's a disregarded entity, so it has a lot of more flexibility to play inside of the TIC structure.
So you're
parent
kind of saying like
taking-
create a straw LLC to like hold the place for the TIC to go into. So after a year, like the syndication, when you form it and everything, you've got, 10 investors or whatever, but having one of those investors be a new LLC that the TIC then kind of like moves into that place in that LLC. Is that what I understand I'm hearing?
Yeah, I mean, you've essentially got one investor who theoretically already has an LLC and has got money ready to be to deployed, right? And the question is how to effectively and easily, smoothly deploy that capital into your next investment. Well, the easiest way is obviously through the TIC structure, in which case a new entity would be created. You, the sponsors, would be the non-member managers of that entity. Your investor is the sole member of that entity. That cash flows into the next deal that's compliant with both the IRS as well as any lending guidelines that you're going to feel out there, with the exception of lenders that don't allow TICs. And then after essentially, if your investor right now has held his investment for essentially a year, it can participate in a roll-up entity depending on the structure and depending on who your lender is. So you have lots of flexibility. We typically send out like a draft org chart to clients to be able to show them visually, because some of us are visual learners. Others of us, can
well,
see
you start getting
Yeah.
so many people in, and it gets pretty confusing pretty quick.
Exactly.
So I've got a couple more questions.
Okay.
When you say a year, does that mean just they filed taxes and then now they're filing taxes again?
Or I mean, they may not have. I mean, it's usually, remember, it's usually tied to the period for short-term capital gains. The period for short-term capital gains is 1 year. So you theoretically, I guess you could have a situation where you still haven't filed a tax return on an entity that's held interest in real property for longer than a year, and the CPA says it's seasoned and it's therefore you can go into the next investment. We typically would defer to CPAs on that, but that's when we talk about seasoning, or for the held for investment time, which is what how the Treasury Department or the IRS defines it. Most CPAs look at that as what's the period for short-term capital gains to get you into long-term capital gains, and that's basically 1 year.
Yes, and that's the 365 days. It's not like if you filed taxes in 2023 and now you're filing for 2024, you've held it for a year. Like,
you're right.
So like, let's say that you bought something in 2022 and now it's 2020, it's April of 2023, and you have to file 2022 taxes, and then you're filing your 2022 taxes and you've held it, and now it's a year out until you file the next return.
Right.
Like, essentially, does it matter exactly when during the year you convert the entity? Essentially, because your next tax return will be different.
Right. Of course.
So, but I mean, essentially, you could do it in December and then, put the entities together in January, and it's shorter term than a year, but there will be 2 tax returns a year apart that are different.
Right. I like to say that the IRS, to a certain extent, should look at substance over form. So what I mean by that is not that we've gamed the system by being able to form an entity, file a tax return, and then roll it up into a partnership entity immediately thereafter, claiming that it's seasoned. The IRS is really looking at, is this a commercial piece of real property? Is this something that you're really trying, that you're holding for investment? What are the facts and circumstances surrounding it? So when we look at tax court cases, because that's how most lawyers essentially look at how courts define some of these areas that AJ said, hey, these may be gray areas, or these may be areas in which CPAs might have a difference of opinion. We're trying to look at the underlying facts associated with the investment. And so we're always trying to reinforce the substance of the investment, so that
and the intention.
They're right. The intention. Exactly. You got it right.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more.
Okay. And so I guess changing subjects a little bit. So when I've got two questions. One is, when people want to get dropped out of an LLC and they did not 1031 in, are there any seasoning requirements on that drop? Or does it you can just drop them before closing and then they just take their boot?
Yeah, that's usually people that are being dropped out, they know that they're going to pay their taxes. So it's not a tax saving device.
Or they could 1031 elsewhere, right?
They could, but I will tell you that most sponsors, operators, syndicators, and that's typically who we represent across the country, would not like that. They don't want that to happen, because that's like
we put in all this work.
Well, no, but imagine this, like the law allows you to have up to 35 ticks in any one deal. But I will tell you, practically speaking, practicing for 24 plus years, I don't know how many hundreds or thousands of transactions I've done. The reality is most lenders are only going to allow you like 5 or 6. And just take your deal, for example. You're on the cusp, you're on the eve of going hard on a sale of an asset. If that is to happen and then the buyer wants to accelerate the closing timeline or even hit a 30-day closing timeline, you generating ballots and then splitting people out into additional entities, the overall cost of the transaction increase exponentially, as well as the complexity of the transaction. And so you're basically, I would say most operators, sponsors, syndicators are giving investors a choice of one choice. The choice is this: do you want to ride with me on the next investment, or do you want to take your cash and pay your taxes? Because anything more than that adds additional complexity, and it potentially challenges your ability to successfully close on the sale of the asset that you're trying to do. Now, it can be done, and I will tell you that Tessa and I have done ticks in less than 24 hours on deals, but it's like your house is on fire and you're running around with like a teacup of water trying to put it out. It's very, very challenging.
Okay. And so that's one scenario where, you've got people who have not put 1031 exchange funds in, but now we've got like the other scenario where we have taken 1031 exchange funds in and it's rolled up. And so then how do you successfully, unroll the entity with the right timing? And is that something that requires seasoning?
Yes. So again, depending on the investor. So if the investor that came in is less than a year, theoretically most CPAs would require seasoning. If you're simply recreating a drop and swap of the
A
original
previous
investors
structure.
who have previously, right? That theoretically they've already been seasoned. And again, remember the form over substance issue. It's more about intentionality and recreating that structure. But I can't really envision a scenario unless you were like, let's say you did you were in a traditional bridge loan, you decided to go into a HUD, any HUD loan, you're on a 30, 40-year AM. So the reality is you're not popping these people out on on a short-term basis on something like that. So
we're
it would
trying to sell our
it would be very
properties every
unique.
5 years. So it's
So yeah. So
it's a
you're
little more-
able, yeah.
yeah.
Go ahead.
It's a little more like active than holding something for 30 or 40 years. And so,
Okay.
And having taken 1031 exchange funds in for this deal that we bought in mid 2023, now we're at 2 years, and honestly, if things turn around and start looking really good, we've done our value add for this property. Like, now we're just kind of riding the market. There's potential we could sell it early, and we haven't even rolled it up. And so one of AJ's big concerns there too, and I think this can be resolved by forming the higher level entity that is an investor in the syndication,
Right.
is how do we get our fees out of the TIC? And yeah, I mean
that's easy. Your fees, whether they're exit fees, guarantor fees, asset management fees, acquisition fees, construction management fees, developer fees, any type of fee that you can imagine can be memorialized either at inception in an operating agreement with a TIC and be compliant with IRS guidelines, or can be an amended and restated operating agreement with a TIC and still be compliant. The difference is that in most people's mindset, the operator sponsor syndicator thinks that their fees are inextricably intertwined with their equity position. And so what I'm trying to encourage them is to think about it two different ways. One, you won't own equity in the TIC entity unless you're the part of the original taxpayer. But two, any fees that have been incurred or expected or disclosed or that the investor is expecting to pay can be memorialized inside of that operating agreement. That's whether you're at acquisition, in the middle of it, at exit, or at a reinvestment opportunity.
So when you say within the operating agreement, like
same question, yeah.
Yeah. Is that within the new syndicate, like essentially the
TIC agreement between the two entities?
Nope, it'll be in the operating. Yep, operating agreement for the existing TIC investor. So the LLC that your investor has, that has an operating agreement. That operating agreement can be amended, modified, restated, or if it was drafted initially, it's setting forth the fees that the non-member manager is charging. So in other words, if every dollar of distribution that flows out, the investor is expecting to, in our hypothetical, receive 70 cents. 70 cents is treated as distribution to the equity member. 30 cents is treated as a fee to the non-member manager on the promote. So instead of having your distributions tied to a 30% equity stake inside of the 1031 or TIC investors operating agreement, your fees are tied to a fee expectation. It's not unlike if you were to advertise on the internet and say, I want to hire somebody. How am I going to pay them?
So Dugan, I think that there's one kind of assumption that whatever entity is coming in with a TIC is some sort of entity, not necessarily a person. But what happens in the case when the TIC coming in is a actual person?
We have to create a disregarded entity. It's a must. Your lender is going to expect it. The IRS is going to expect it. So, and when I say disregarded entity, it's a limited liability company. So a simple limited liability company is created. The the EIN, like the taxpayer identification number that is used for that entity, is likely the social security number that's tied to the individual investor. And because it's a disregarded entity for taxation, for 1031
member LLC. So that's different than the partner. The partner LLC needs a partnership EIN, whereas a single member LLC is essentially just a, disregarded entity. That has legal limited liability status. So it's not like a DBA, or an assumed name.
Nope. It's an actual entity that will serve multiple functions for them. It will provide them asset protection in the investment. 2, it will provide essentially that safe harbor provision for the 1031 stuff. And 3, for you guys, it provides you a legal mechanism whereby you can essentially charge the promote, the fees, or mirror essentially what you would receive had they invested as a retail investor.
And so we're helping them form their operating agreement and inserting us as a non-member manager for that LLC. And you were mentioning the layered LLC up above that disregarded entity, and that is a function to roll up by having that second LLC own 100% of the disregarded entity.
Yeah, you wouldn't need that. You wouldn't need that unless the original taxpayer was an entity. If the original taxpayer, the original investor is an individual, they won't need that multiple layers because you'll be able to set up your fees and all of that right up front. If they are an entity investor, meaning they currently hold their investment as an LLC, and the LLC is recognized with an EIN, and it's recognized for IRS purposes as the original taxpayer, your lender likely is going to require a new LLC to be formed to sit on top of that. That can be treated as a disregarded entity. And the reason why is every entity has a history. Even if you promise, you swear on a stack of Bibles with your lender, hey, I've never done anything bad with this LLC ever. They just don't want to take upon themselves the contingent liability associated with that. So that layering effect allows the lender to remove any contingent liabilities that may exist with that entity investor, but it also allows you the same mechanism that you would have if it was an individual investor and you were going to form a new entity for them. You were going to give them an operating agreement. You were going to insert yourself as the non-member manager. You were also going to put your fee schedule in that operating agreement. Both of them allow you the same mechanism to achieve the same objective.
And I'm sorry, but I get into the weeds here very much. But when you're kind of like moving that around and creating these disregarded entities, I understand like at the beginning it's you create that, but you season it for a year. Is it a transfer, a sale? Like how does it actually move into the new disregarded entity or roll up? Like what sort of function, or how would you describe that?
The paperwork.
Yeah.
What is the paperwork?
depending on the state where the entity is located, where it's formed, it can be as simple as amending and restating the operating agreement. It can also be done through a simple conveyance, meaning it's just an assignment of interest or an assignment of membership rights. It can be an actual purchase and sale agreement that exists between the new entity and the old entity. Any number of ways.
We often use quick claims. When you say conveyance, is that like a quick claim? So it's like we often there's one form that we use that's like, oh yeah, we messed up the name and this is a quick claim into the right name.
Right. Quick claim deed, special warranty deed, general warranty deed, all of those are 3 ways in which you can convey a piece of real property to another entity at any given time. Quick claim just means, hey, you're just getting whatever I have. I'm not giving you any warranty or representation as to what I have. I'm just putting it in there. We use that a lot of times in real estate transactions where you've got the legal description is different on the updated survey from what the vesting deed is. And so you might have a transaction where you'll have a special warranty deed or a general warranty deed and also a quitclaim deed in the same transaction. But you're right. That's just a form of conveyance.
Okay.
So I guess when we're dropping people out of an LLC so that they can take boot, can we just give them the cash and say that, or is it we're needing to drop them out, assign a certain dollar amount to them, and then they take their boot?
Yeah. So the mechanics of it are, remember, back to our original hypothetical, we send out a ballot to our investors. Yep. We now have two camps. We've got the camp of the people that want the exchange and the camp of the people that don't want the exchange. The people that don't want the exchange are being dropped into a new limited liability company. Same structure as that exists in the exact ownership. Your cap table is changing, meaning you're going to have to do some math on what their percentage of that new entity is owned, such that now from a title company's perspective, all they really care about is let's say you're going to get $1 million in gain on the sale of this property. The title company is going to say, okay, guys, what percentage goes to this entity and what percentage goes to this entity? And then on the statement, on your HUD or your settlement statement, it's going to have disbursements that will flow out. One will be to a qualified intermediary of, let's say it's 50. Let's just make it easy math. 50-50.
Yeah.
Right. 500,000's going to this QI on behalf of the seasoned entity that continues on with the investors who want to go through the exchange, and 500,000 is being distributed over here to Newco associated with that. So that's the way that it's usually works.
Okay. Awesome. That makes a lot of sense. And then the new company will receive the money and then distribute it as it pleases.
You're gonna issue final K1s from the new company to your partner, to your investors, just like you have all of the other years, right? That new company is going to file a final tax return. I usually tell clients, I said, before you dissolve a company, or certainly before you kick out 100% of all the distributions, hold back a little amount of a contingency, right, to wash payables and your receivables through the system.
Do you have any suggestion on what sort of amount or what sort of percentage to hold back?
Yeah, it kind of depends on the size of the scale, right? So common sense, if we're talking about a $50 million office building with multiple tenants and 50,
we're not that big. We're not that big.
I get it, but so you're probably, I would say you're going to hold back $5 to $10 grand probably to wash through the system, depending on what your CPA is going to charge on the final thing. Because I've had clients, unfortunately, that have had to do clawbacks, or they've had to ask the investors who receive distributions, please give us money back because we don't have enough money to actually wind down the company after we've sold the asset and the company no longer serves any purpose for its existence.
Well, what if
you don't want to be put in that position?
All of the funds forward and they're locked up in with the intermediary.
Chris, the swap you're not winding down. It's just when the drop in the boot is a new LLC that you wind down and close.
There could be outstanding bills that just come up,
Right.
A contractor appears who says they're owed, 6 digits. And
that's right. That's why typically what you want, even if you're the exchange entity, you're going to want to have a title company that understands the TIC process, and that they will withhold and not distribute 100% of all the proceeds to the QI. So they will withhold a certain percentage to, again, wash out whatever the true up is on any bills that are outstanding. So on both sides, right? Because otherwise what happens is you're gonna eventually have to you're gonna have to inject new capital into that exchange entity to pay the bills, because you've washed 100% of whatever that money is from the title company into the QI. So the math is real important here, right? So the math on both the cap tables as well as the percentages of what you're going to get on those distributions is super important, and being able to forecast what your outstanding bills are from an accounting perspective.
And Dugan, another question that like kind of like comes to my mind with, you know, exchange and companies and everything like that. I mean, like, what do we do with the operating account? Like, I mean, we've usually got, you know, $10,000 to $30,000 in the operating account. Like, do we, you know, send that to the escrow company and say this is part of the exchange going forward, or do we just?
You can, but remember that's already after tax dollars, meaning you've since you've touched it, it's in your operating account. I wouldn't kick it into title. You may be transferring part of that operating account to the new co, depending on that percentage, because they're rightfully own a piece of whatever those funds are that's in your operating account. So you'll be transferring between accounts some of that money depending on the percentage of undivided ownership interests in the new entity that you're setting up.
I guess we could probably just take that as use that money to pay our fees.
So are there any money handling, I guess, no-nos when it comes to transfer? I mean, obviously there's the big, you know, you can't touch any of the proceeds from the sale. Right. But are there any other money handling like rules that need to be observed?
That's the big one. And then we revert to what our mom has told us: don't lie, cheat, or steal. Right. Other than that, we just want to make sure that we're just making sure that we don't touch that money that's coming from the title company.
And then like if we're holding back funds from the qualified exchange to make sure that we've got money for bills, like let's say that we held too much, that's just taxable funds at this point?
That's right.
And so yeah, and so the exchange group will get a distribution of taxable funds. So like that's a possibility. Like in the money in the operating account too, that will be a distribution to all the investors. Correct. And everyone's gonna have to pay taxes on those.
Yeah, but it's a little piece of what we call boot, right? So like it's not even a rounding error usually on these things. It's more important from your perspective to make sure that you have ample funds to take care of all the bills associated with the transaction than it is than investors are going to expect that. Remember that going into the investment, they were never guaranteed not paying taxes. So there's not an expectation that they're not going to have to pay some form of taxes associated with the process.
Dugan, we really appreciate your time, and I know that we're coming up on the hour mark here. Are there any questions that you think we should be asking right now?
I don't think so, man. We've exhausted this thing. You guys are extremely deep. You guys went real deep into my bag of tricks to get all this stuff out. But I really am a big believer in this, guys. I really am a big believer in providing diversified streams of income or capital to sponsors, operators, and syndicators. So people out there that are scared or that they're afraid of doing ticks or trying it, I just say you're harming yourself from a massive opportunity to garner an independent stream of capital. So the tick investors largely think about investing different than people that are investing with after tax dollars. In some ways, it's often easier. So I'm a big believer in it. I'm encouraged by it. I mean, there's billions and billions of dollars that will be exchanged this year via 1031. It's my favorite part of the tax code. So I'm glad that you guys are in the investing game and that you're offering this to your investors. It's super important.
I really love how you describe the, I guess, tick investment as a stream of income, as a separate stream that flows into a bigger river, and something that should be considered being built by, an investor. And I think that we'll definitely use that idea. I do really like it, and I'll make sure that you get the credit for
All right, I'll take
planting that little seed in our head. Yeah, it's been really, really awesome to get your knowledge on this, and we look forward to working with you too.
All right.
So we'll send you some stuff. We were looking at a deal yesterday, and yeah, exciting times.
All right. Thanks, guys. Appreciate you.
Yeah. Thanks for coming on our podcast.
Of course, anytime.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.